GameStop has announced dividend of warrants to shareholders. This video will be a full rundown and an explanation of what is going on. GameStop declaring a special dividend, but instead of handing out cash, they're giving shareholders warrants. What are those? Rights to buy additional shares of GameStop in the future. Could this finally be the start of MOAS? Are they attacking the shorts? Is this a way for short sellers to get screwed? Let's go ahead and get started. If you're new to the channel, please give me a thumbs up. Please hit that like button, subscribe, and let's go ahead and get started. Today, GameStop has announced a special dividend to be distributed in the form of warrants to holders of the company's common stock. As of October 3rd, 2025, if you hold GameStop shares, you will be given a dividend by GameStop in the form of warrants. Each shareholder as of October 3rd, 2025, will receive one warrant for every 10 shares of GameStop that they hold. The company expects to distribute up to 59 million warrants on Tuesday, October 7th. And each warrant will entitle the holder to purchase one share of common stock at an exercise price of $32. So what does this all mean? One of the main reasons, of course, is to raise more money. Are they trying to raise the floor again? If they sell 59 million warrants, they can raise up to $1.9 to $2 billion. Remember on that previous video that I just posted, they currently have $8.7 billion in cash plus the $500 million they have in Bitcoin. If they sell all 59 million warrants, they will be raising 1.9 to another $2 billion in cash. GameStop will be sitting with over $11 billion in cash. This will raise the floor once again. This is the greatest show of all time. This is the greatest show of all time, guys. What the heck is going on? These funds would go straight to general corporate use, such as investments or acquisitions on GameStop's balance sheet. It is also a non-dilutive way to raise capital initially. GameStop won't receive cash unless you exercise your warrants, which, why wouldn't you exercise it if it's free money from GameStop? So everyone will probably exercise it. GameStop has rewarded their shareholders with free warrants without any payment required. You have until October 30th, 2026 to buy shares to exercise those warrants at $32. This is a unique and potentially lucrative opportunity, but don't forget that timeline. What does it mean to exercise your shares at $32? Basically, a warrant is a coupon that lets you buy GameStop stock later at a fixed price of $32. No matter what the stock is trading at, you'll be allowed to buy GameStop shares at $32. So let's say GameStop short squeezes up to $50. With your warrants, you're allowed to buy GameStop shares at $32 and instantly sell it in the open market at $50. Now, what does this mean for the short sellers? This is where it gets a little spicy. Remember, they have already figured out a way to set the floor on GameStop by issuing convertible debt. GameStop is pretty much at the floor right now. $10 billion valuation, the liquidation value is pretty much equal to the market cap. They're at the floor. That's why from summer of 2024 until today, it's pretty much been stuck at the same levels. Now, what happens to the short sellers? If you're a short seller, you will have to owe the dividend also with these warrants. So let's paint a scenario. If you're short GameStop, you borrowed shares and sold them. You don't just owe the shares back. You're also responsible for delivering whatever dividends comes with those shares. So since this dividend is in warrants, the shorts must make sure the people they borrowed from still get their warrants. So that means extra cost and complexity for the shorts. So now they have to worry about the floor of GameStop with the convertible debt, with the amount of cash GameStop has been holding and the improvements in the financials. Now they have to worry about the dividend of warrants to shareholders. Another problem for the short sellers. So there's going to be pressure in the markets. Let's just say people start exercising their warrants at $32. If lots of holders exercise their warrants, more shares enter the market. But here's a twist. This is where it's going to create some uncertainty for the shorts. They don't know how many new shares could hit the market. And remember, they still owe the warrant value to whomever they borrowed the stock from. This can cause a potential squeeze fuel. The shorts now face the normal cost of borrowing GameStop stock, responsibility to cover the warrant dividend, and the possibility that retail holders won't sell their warrants cheap, forcing shorts to pay up. So now the shorts have to buy your warrants. Now this will create a demand for the warrants. So in the end, they're going to have to buy your warrants. This can increase the cost of staying short and sometimes pushes shorts to close their positions early, buying back stock, and once again, driving up the stock price. Is this finally it? Is this the start of MOAS? Has Ryan Cohen trapped the shorts with this dividend of warrants? There's a lot of stuff happening in the background, a lot of the derivative stuff that I don't understand with GameStop. I know this thing is connected deep in the financial world that we don't even know about. But all we know is shorts will have to cover this too, making their lives harder and potentially more expensive. I don't know if this will automatically cause a short squeeze, but it turns up the heat, it makes things spicy, and gives the GameStop shareholders more leverage. And so, if you're a normal shareholder, sit back, relax, you're about to get some free warrants. If you're short, you have to deliver the warrants that you don't have. That means that shorts either buy the warrants on the open market, they're going to want to buy our warrants, driving up demand and the price of the stock. Or they're going to have to negotiate with brokers to make sure their borrowed shares are properly accounted for. Either way, whatever happens, it's real cost and risk for being short this company. If GameStop happens to be trading at $50 and shareholders exercise their warrants at $32, and GameStop raises billions, once again pushing the floor. For shorts, this means more potential shares to cover and a stronger company to fight against. If the fundamentals improve and the cash keeps growing, institutions keep on buying, the short thesis has gotten weaker and shorts must close. Last question, guys. What about naked shorting? Naked shorting is an illegal practice of selling shares without first borrowing or owning them, creating phantom shares. So these are fake shares that they're creating out of nowhere to pump the stock of these companies down. They're called phantom shares. It's used for market manipulation. It's a loophole that the market makers can make. Basically, it's unfair to us shareholders. With naked short selling, the trader simply does not deliver the shares if we decide to close, resulting in a failure to deliver. So how does this attack the naked shorts? Well, if there are phantom and naked short shares out there floating around, those shares don't get warrants because they're not real shares. They're just fake shares. So now that means some brokers now face a mismatch. Their clients are expecting warrants, but those warrants don't exist for phantom shares. The only way to resolve this mismatch is for brokers or short sellers to go out and buy real warrants on the open market to satisfy that obligation. This dividend of warrants can actually corner the naked shorts. Again, guys, this is all kind of just like theory. We don't know what's actually going to happen. If short sellers scrambles to buy warrants, the price of GameStop warrants could skyrocket because they're going to want our warrants. Those phantom shares, they're going to have to deliver it to the brokers. They're going to have to deliver the warrants to the brokers. Where are they going to get those warrants? From us. So the warrants are going to skyrocket, right? Maybe. What else could happen? Short covering pressure. Added costs and risk may force shorts to close positions, causing the stock to rocket. If lots of warrants are exercised, GameStop raises another $2 billion in cash, which makes it harder to justify the bearish short thesis. They've already created a floor, but GameStop just made it way more expensive and complicated to stay short. And if enough people exercise their warrants, it could both give the company a ton of cash and force shorts, especially naked ones, to panic. All right. So here's the bottom line. GameStop just handed out the warrants like golden tickets to shareholders, and now short sellers are stuck with the bill. If the stock rips past $32, these warrants could turn into serious profits for us. Fresh cash for GameStop, raising their cash holdings above $11 billion, and a massive headache for shorts. This isn't just a dividend, it's a move that changes the game. They've already changed the game with the convertible debt. They've already changed the game with Bitcoin, and now they have the dividend of warrants to shareholders. So what do you think? Will this crank up the pressure for short sellers and spark another squeeze? Could this be the biggest corporate squeeze we've ever seen? Could this be the greatest show of all time? Or will the market just brush it off? What if this is just a nothing burger and we're stuck with GameStop for another year at $24? Let me know what you guys think in the comments below. I would love to hear your take. If you found this breakdown helpful, please give me a thumbs up, like, smash that subscribe button, and thanks for watching. I'll see you guys on the next one. GameStop to the moon, baby.